You are familiar with the taxes that arrive with official notices. The income tax that shrinks your paycheck each month is a stark reality. You see the sales tax added to the bottom of your receipt when you buy a new shirt or a coffee. If you own a home, the property tax bill lands in your mailbox with a heavy thud, a demand from the local government that you cannot ignore. These are the visible taxes. They are lines on a form, percentages debated by politicians, and figures you can calculate and plan for. You can argue about them with your neighbors, vote for people who promise to lower them, or hire an accountant to navigate their complexities. They are a known part of the financial landscape. But another tax exists, one that operates in the shadows of your daily transactions. This tax does not come with a bill, it is not listed on any government form, and no elected official ever campaigns on its rates. So, what exactly is this powerful yet unseen force? An invisible tax is money you lose to the inherent structure of the financial system. It is not a conspiracy, but a consequence of a system designed to allow various players to take small, automated slices from the flow of money. Banks, corporations, platforms, markets take small, automated slices from the flow of money. Each slice is tiny enough to go unnoticed. A 2% fee here, a 0.5% charge there. When these slices are taken from millions of people, millions of times a day, they add up to colossal sums. This is how your wealth is slowly eroded, not by one large event, but 1,000 tiny cuts you barely feel. You encounter it as bank and credit card fees, monthly maintenance charges, overdraft penalties, foreign transaction fees, late fee. It exists in payment processing spreads. When you buy something online, the seller loses a small percentage to the payment platform. That cost is passed on to you as a slightly higher price. It is there in investment management fees. A fund manager charges a small percent of your assets each year, directly reducing your future gains. Small percentages are deceptively harmless. When you see a 1% management fee on an investment fund or a 2% transaction fee on a purchase, your brain registers it as a trivial amount. 1% of $100 is just $1. It feels insignificant, a small price to pay for a professional service or the convenience of a quick payment. However, this intuition is dangerously misleading because it fails to account for the power of compounding over time. Just as your money can grow exponentially through compound interest, the cost of fees can also compound, creating an ever-widening gap between what you could have earned and what you actually keep. Let's walk through a simple but stark mathematical example. Imagine you invest $10,000 for your future. You find an investment that historically returns an average of 8% per year. If you let that money grow for 30 years without any fees, the power of compounding would turn your initial $10,000 into approximately $100,626. That is a fantastic result, a more than tenfold increase in your original capital. But this scenario rarely exists in the real world because the invisible tax of fees is always present, working against your growth. Now let's introduce a seemingly tiny 1% annual management fee. Your net return is no longer 8%, but 7%. The fee is taken out each year, reducing the base upon which your future earnings can grow. After 30 years of compounding at this 7% rate, your $10,000 investment would grow to only about $76,123. The difference is a staggering $24,503. That single 1% fee did not just cost you 1% of your money. It cost you nearly a quarter of your potential final wealth. Among all the invisible taxes, inflation is the most widespread and perhaps the least understood. It is not a fee you can find on a statement or a charge you can dispute. Instead, inflation is a gradual and persistent decline in the purchasing power of every single dollar you own. The money sitting in your checking account, the cash tucked away in your wallet, all of it buys a little bit less tomorrow than it does today. This slow erosion of value functions as a silent tax on anyone who holds cash, on anyone who earns a fixed income. It is a subtle transfer of wealth that happens right under our noses every single day. When a central bank creates new money, it doesn't just appear in everyone's bank account simultaneously. The new liquidity is injected into the financial system at the top. It flows first to large commercial banks, the government through bond purchases, major financial institutions. These players get to spend the new money at its current value before it has had a chance to circulate widely and cause prices to rise. They can buy assets like stocks, real estate, commodities. That pushes up asset prices. This is the first wave. By the time this new money trickles down to the general population in the form of higher wages or economic stimulus, the second wave has already begun. Finally, there is the tax of the intermediary. Very few things travel directly from creator to consumer. Manufacturer, distributor, wholesaler, retail platform, you. At each step, a middleman takes a cut, adding cost to the final price. The same is true for services. Sell a house. A real estate agent typically takes 5 to 6% commission. Buy concert tickets from a reseller. You pay a hefty service fee. Wire money overseas. The bank slices value through exchange rates and transfer fees. The economy is full of these toll roads. The price of admission is built into participation. Value is often extracted by occupying choke points in transactions. Banks profit on the spread between deposit and loan interest. They are middlemen for money. Digital platforms gain power as intermediaries between millions of buyers and sellers. Middlemen can provide real value and access, but their fees are a constant, hidden tax for convenience. The more layers between you and the source, the more tolls you pay. The true genius of the invisible tax is its subtlety. The system hides costs in a blizzard of tiny numbers across dozens of transactions. You see a $2.99 service fee on a food delivery app, a 1.5% foreign transaction fee on a credit card statement, or a 0.75% expense ratio on a mutual fund prospectus. On their own, these figures feel insignificant. It's easier to pay than to find an alternative. This is a calculated design using human psychology. Our brains don't grasp the cumulative effect over long periods. We don't add up 100 tiny fees each year. Financial institutions know this blind spot. They profit from consumer trust and inertia. A 1% fee taken from one person is small, but 1% taken from millions becomes massive, reliable revenue. This is not the work of a secret cabal or conspiracy. It's the logical result of system incentives. Corporations maximize profit. They hire smart people to do it legally and efficiently. They build automated systems that collect small amounts from many users, often without them noticing. The process feels normal and frictionless, which is why it's so difficult to resist. The slow drain only becomes apparent after decades. Two people with similar incomes can end up very different financially later in life. One person may have unknowingly paid tens of thousands more in fees, interest, and inflationary losses than the other. The pinch is a dull, chronic ache you only recognize in hindsight. By the time the full cost is visible, it's often too late to recover what has been lost. The invisibility of the tax is its greatest strength, allowing it to operate without opposition. You cannot completely opt out of the system that charges these invisible taxes. To live in the modern world is to participate in it. However, you are not powerless. By becoming aware of these hidden costs, you can take deliberate, practical steps to minimize their impact. The visible tax funds government. The invisible tax funds systems. Learning to see it is the first step to beating it.